Good day, my friends. Tracy Repchuk here. I'm the host of Reach Millions TV, an entrepreneurial lifestyle and learning channel where I educate and introduce you to some of the greatest powerhouses in their field. As an entrepreneur for over 37 years, I've had the good fortune to appear in Forbes over 27 times, speak in 39 countries, appeared on NBC, ABC, CBS, Fox, won awards from the Senate, the Assembly, the White House, and President Obama. I've written 9 #1 bestsellers, and from that journey, I reached millions with my message. So I wanted to show you how, with specialized trainings and introducing you to people that can help you find more leads, make more sales, and reach millions with your message. Now, you can find out more about me at tracyrepchuk.com and reachmillionsacademy.com. Now, today I'm joined by a financial wizard, Kathy Peake. Kathy is the CEO of the Peake Financial Group and brings years of experience as a business owner, mother, teacher, and financial and insurance advisor. Kathy specializes in working with single moms and widows to help them achieve the confidence and security in making informed decisions with their investments and insurance to fulfill their dreams. Kathy, welcome to the show.
Well, thank you, Tracy. It's an honor to be here. Such fun to see you, and known you for several years now, and it's just really exciting to be here. So
awesome.
Thanks.
You're welcome. Well, let's start with, what led you to the path of financial advisor and dealing with insurance? Is that love of numbers?
No, not particularly. I have a degree in chemistry and a minor in math, but I found myself kind of in a midlife situation where I needed to transition from being a stay-at-home mom and find something that would support me and my kids. And I wanted something, since they were still at home, I was looking around for something that I could have some flexible hours, do something that was interesting. I'm a very caring and helping type of person, and I love getting to know people. So I was continuing to pray and look, and this ad came up about making 6 figures and having a flexible schedule if I wanted it, and managing people. And I was like, well, I could do that. I've managed 3 kids. And so I interviewed. When I got into the business over 20 years ago, I didn't actually personally know much about the financial industry. In fact, I didn't know the difference between a stock and a bond. I didn't get the money memo when I was a kid. My father was an airline pilot. So, we didn't talk about money. He had a pension. And so saving for retirement and talking about those kinds of things just wasn't done very often. I mean, we did talk about savings because I had the typical kid savings account, which I thought was just a ton of fun to see that number grow and grow. But it was a savings account. And I was a good saver, and I liked that, but I really didn't know anything. And I honestly thought that you needed lots of money from someplace to be able to start investing. And you really don't. You can start with about $250 to $500, depending on the company, and then a commitment of at least $50 a month to get started. So, just about anybody can start saving for retirement, for travel, for, buying a new house, kids, college savings, whatever you want to save for, there's different ways to do that. And certainly if you inherit money, that needs to go someplace besides in the bank, because the bank's not going to take as good care of you as somebody that's a professional. So that's kind of how I fell into it, and learned a lot. And I kind of consider myself like a financial teacher now. I love to educate. I taught high school chemistry for several years and enjoy doing that. So I love the teaching side of it. And I think I teach my clients enough, and they're mostly women, and I don't make them feel like they have any shame that they don't really know, because I was almost 40 and didn't even know, really. And if I had only known way back when, but that's not the way it went. So I understand them, and I help educate them enough so that they can make an informed decision and feel comfortable with it. And so, they don't have to become a financial advisor, but they have to understand what they're doing and why they're doing it, and which particular way to go, which product or fund or whatever is the best for them, and make those choices.
Now, I've noticed you work with women, and two groups in particular you mentioned, which are actually very vulnerable groups, and that is the single mom type of scenario and a widow. Tell me about that choice.
Well, I have never been a widow, but I have been a single mom. I've been divorced enough to be smart about it now. And so I understand them. And being, coming from an education background, I love to educate, but I'm also very caring, as I mentioned before, and I love to listen. And so I get to know them. I get to know what their issues are. So I almost become a financial doctor, financial therapist, I don't know. And I help them, explain what their situation is and how they ended up in this situation, help them make the right decisions. Many women just didn't get the money memo either. And they've turned over, in a lot of cases, their decisions to their partner. And then when that partner is not there any longer, it's like deer in the headlights. Now, what do I do? And I find that they are very vulnerable. And unfortunately, not all, but a lot of male financial advisors don't take the time to listen, because they were probably working with the partner before. And if she ends up with the same financial advisor, especially in a widow situation, the husband, Bob and I have known each other for 35 years. We're going to continue doing what Bob did, but she's like, I don't know what that is. Is it the right thing? That kind of situation. So a lot of times they just don't do anything. They just put their fingers in their ears and go, la, 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 and they hope. And I like to educate them and find out more about them, so I know what kind of money mindset that they have. And there's lots of fun explanations. I've written a lot about different money mindsets. There's the hippity dippity, which are usually women who, give and give and give, and, the universe is going to provide. And I don't need to know all of that kind of stuff. And then there's the squirrel who wants to gather it all together and hold on to it. And they usually save it in the bank, which is, because of inflation, probably not the best place to put it. So understanding, what their comfort level is with money, and where the money came from, what their goals are. Every single individual person is different, and they don't have the same path. They don't have the same goals. So I do needs-based financial planning.
I'm sure that's very helpful, because I don't know many women really. I mean, I'm a certified management accountant, and the only reason I got that designation was because I was a software developer, and my software integrated to accounting modules such as, ACPAC and Great Plains and Sage and things like that. So I wanted that extra, kind of like credibility, so that everybody was confident that my software was going to work. But other than that, even in the position I'm in, I would much rather somebody else kind of, I monitor it, but I definitely like when somebody else says, you should do this, because I'm not looking at anything in the industry.
Well, that's what I call the queen money mindset. And that is, she understands she's large and in charge, and she has her minions that she works with, so that she understands what she's doing, but allows others to help her manage her money. and so that she can go on and do the things that she definitely needs to be doing, just like how you work in the world and making it a better place. Spending a lot of time dealing with your money is probably not the best use of your time and expertise. And so that's why I say I educate them so that they can make informed decisions. And then we meet as often as they would like so that we can review it and make sure that we're hitting all those goals along the way. But I also find with business owners, they tend to be working so much in their business and on their business and day to day, they kind of think that maybe they'll be able to sell their practice or their business down the line, and that will be their retirement. But that's not the best way to go. It's time and consistency, putting a little bit away all the time from what you're making now can help you not necessarily retire. My grandfather always used to say, there is no retirement in the Bible. And retirement really is a very new concept. It only came during the Depression, to be honest with you. Social Security was a way to get the older folks out of the workforce so that give them an incentive so that the younger family, the younger folks that have children at home weren't starving. And so that they could actually kind of move up in the system and be able to make more money. So Social Security really created this whole retirement mindset. But back then men typically only lived to 65.
Yeah.
So you only had it for 2 or 3 years. Now, Social Security is lasting maybe 30 years.
30.
Yeah, 30, 35 years because people are living longer. And, I tell my younger clients, don't even count on it. Just if you get it, if you have it, if you're, if there's something there at that point in time, great, it'll be gravy. But don't count on it.
Exactly. Count on it. Count on that being a nice lunch every month or something,
That's right.
Yeah,
but I also want, especially business owners or anybody really, to be able to then have an opportunity to choose what their later years look like. Because I don't know about you, but for me, retirement just means boredom,
Oh yeah, I won't be retiring. I mean, for me, I'll be traveling, right? It'll be, and not just for the sake of traveling. I have a lot of philanthropy connected to that, but that's where I'll be headed.
Right, and speaking and traveling and writing it off on taxes and, doing those kinds of things. A lot of people after the first 6 weeks of playing golf are a little bored. And so, being able to work part-time and having that choice. For some people, they don't have that choice. They didn't start saving until they're in their 50s or 60s.
Right.
And so they have to continue to work. And their choices later on in life are not very good. So starting small is something that I always advise. Don't go crazy with your lifestyle and think that you need to save $500, $600, $1,000 a month. And then you get so fatigued because you don't get to have any fun when you're younger and do some of the family travel or, do things that you really want to do. But be conscious of, do you really need the bigger car? Do you really need the extra stuff in your life?
Right.
Rather, sock some of that away now. And that's actually where the book, The Millionaire Next Door, kind of comes into place, where there are a lot of people who have a lot of money, live in very humble means. I mean, Warren Buffett still lives in the same house in Omaha, Nebraska, and that he's had for years and years and years. He doesn't have to, but he's of the mindset that why not? This is a fine enough place. Yeah. So if he can do it, I can do it.
Yeah. That's right. Squirreling away, right? Into investments and into things that you can identify as being, low risk, high return. And that's really what it is, right?
Yeah.
So
Yeah, and
what's something most people don't know about insurance? And if they did, could like save them.
right. Well, insurance is one of those things. Either you have a good feeling about insurance and you or you don't. But you insure your car just in case. You insure your house just in case. Well, life insurance is not for a burial plot. The way that life insurance can and should be used is
Mhm.
you can't replace the person, but you can replace that earning income.
Mhm.
So the thing that I like to use as an example is if you have a couple, they're both working, there's kids in the family, there's some reason to have insurance. That's always
Mhm.
an important thing. But if they both make 50,000 and one gets hit on the highway on the way home from work, going from $100,000 income to a $50,000 income is really tough.
Mhm.
And so if you insure that other person, either one of them, for say $500,000, that's about 10 times what they make. So
Mhm.
$500,000, you get that insurance money tax free. That's a very
Mhm.
important thing. And you can invest that money. And then as it's growing, you can replace that monthly income by drawing on a monthly basis, but investing it so that it gets an 8 to 10% reserve. Rate of return on
Yeah.
average. And so that you can be drawing some of that money out to replace that income that's been lost. So that's the primary way. You can
Mhm.
also use insurance, and a lot of people, and even a lot of divorce attorneys, don't advise this, but in a divorce situation, you should absolutely have insurance on the spouse that may be paying alimony, child support, because you are so out of luck if that
Mhm.
person dies and you don't have that alimony and that child support coming in and you're expecting that and need that. Ensuring that person, at least until the kids are out of college,
Mhm.
out of the house, no longer, hopefully by that time you've got yourself in a situation where you don't need that. But even for stay-at-home moms, very important to have insurance on her, because if something happens to her, either by an accident or a death from an illness, there are a lot of people that died during this whole COVID thing and they didn't have insurance
Mhm.
and to replace their income or to replace what they do. They
Mhm.
estimate that a stay-at-home mom, if was paid to do all the things that she does in the home, would be about $350,000 a year. So to replace that, there's two things that can happen. Number one, if she's no longer there, you may want to hire somebody to come in, like a nanny, housekeeper, driver, all of those
Mhm.
things that the stay-at-home mom does, but also insure her so that if she or he are no longer there, that maybe the mom or the dad that's continuing to work can then choose how much they work or where they work, or they just may want to use that insurance money to replace their income. And then they become a stay-at-home dad or a stay-at-home mom. So insurance is to replace income. It's also very important in a key person situation for business owners. So if you've got either a key person or you're in a partnership, um, or you're the sole owner of a company, to replace your income for your spouse if something
Mhm.
happens to you and you're no longer able to be in the business, continue the business, having enough insurance to replace that person until, for instance, with a key person, they're gone and your business isn't running because they were very key to the functioning of your business and the income of your business. So
Yeah.
having insurance, as long as you have an insurable interest, you can actually own insurance on anybody, but you have to have insurance. I couldn't say, gosh, I like Tracy and, you know, I think I'll ask her if I can have insurance on her. It doesn't work that way. It
Right.
has to be insurable interest.
I remember when the kids were growing up, we had me insured for 5 million because
Right.
of being the sole owner or the sole earner, so to speak.
Right. Right.
And that if so it was a double, right? We had the key replacement and
Right.
the fact that everybody had to continue to live in a lifestyle that they had become accustomed to,
Right.
and to be set up for decades and, you know,
Right.
years to come type of thing. So yeah,
Absolutely.
I think it's very important to do that assessment, and to properly, you know, even it's not a question of, oh, gee, I don't want to think about something happening.
Right.
You know, you just want to be protected, like you say, right? You just want to have that safety net, and it's either for yourself or it is for another.
Right.
You don't want to leave anybody with either debt or an inability to continue on the way they were used to.
Absolutely. And I even
Yeah.
advise a lot of my younger folks to start insurance very, very young, because it's extremely cheap, very inexpensive. And then they just never know what their life's going to look like. I had a 17-year-old client who had a Roth IRA and he had life insurance. And by the time he got married and was ready to buy his first house, he had more money than some 40-year-olds that I've worked with. So starting young, having at least a level amount of insurance, 100,000, 200,000, something like that, so that if you can't be insured, who knows? You might end up with diabetes, you might end up with some kind of heart issue, who knows? And then speaking of that, long-term care insurance, especially for single women or single men, is very, very important, because you may not want to burden a family member with taking care of you, whether it be a long time from now, but a lot of people end up in a car accident or have an illness that suddenly comes upon them, and they have no one to take care of them. And so long-term care insurance is a niche product, but it's definitely something to be looked at and discussed with a financial advisor. So, and speaking of insurance, I really recommend that people find a securities licensed insurance agent, because if you're non-securities licensed and you're just a plain insurance agent, they can't offer you all of the different variations of variable annuities, variable life insurance. They only can do fixed products. And so a lot of people don't realize that, and they get not the best overall type of insurance for them, because you can also use insurance as a little savings portion that is tax-free. And so it's kind of like a Roth IRA inside of an insurance product.
That's very cool and very informative, because I often know people they like either avoid or don't talk finances, and they avoid or don't talk insurance. You know, either like they're two big taboo subjects almost. And so given the field that you've been in and the experiences that you've had and the journey you've taken, what's the biggest challenge you've had to overcome?
Well, my biggest in my particular practice is that I'm not really good at marketing. I'm not good at blowing my own horn. Sometimes it takes somebody else to blow my horn for me, because my clients adore me. So that's my biggest hurdle, is getting the word out about me. But I've seen so many women who just don't do anything because they're scared, or they're depressed, or they're insecure about, or they feel a lot of shame about where they're at and what they know. And I just try to encourage people to get educated, to start with somebody that can help you. Just get started. Take that first step. A lot of women who are divorced don't know that they can claim on their ex-husband as long as they've been married, and they're not currently married, as long as they've been married 10 years or more, they can claim on his Social Security. So I'm constantly meeting with women who are like, what? I can do what? Because they're scared. You know, they weren't in the workforce making a lot of money and the spouse was. And it could, and this is not a sexist thing. It can be the other way around. You know, he could be the stay-at-home dad and she was the powerhouse out there working and making the money. Yes.
Yeah.
You know somebody like that, right?
I know someone like that. Yeah.
Yeah. And that doesn't, you know, decrease the other person's worth, their self-worth or their self-respect. It's just the way that it is. And so knowing what the laws are, knowing what the rules are, and working with a financial advisor, you know, having a good relationship with a lot of the professionals around financial advising, you know, a banker, a lawyer, you know, a trust attorney, all of those kinds of things. But at least beginning to put your toe in and, you know, saving $50 a month until you can afford to start something like a mutual fund in a Roth IRA or an IRA, depending on, you know, your particular situation. But meeting with somebody, I don't have a minimum. Some financial advisors won't even talk to you unless you have 250 million or more. You know, not million, 250,000 or more.
Yeah.
But I don't have a minimum, and I start people early and young.
And that's a great thing. You know, you mentioned early, I started my first RRSP at the age of 16. My parents had no idea what I was doing. I literally contacted a financial advisor. I still have him to this day, which is totally funny because I've lived in different countries. I've lived all over, and he is still where he is. And so he has been, you know, my advisor since a very early age. And the good news about if marketing is your weakness, you can hire people like myself to align and get you going and to make sure that you're optimizing products and things like that. So now, what was one of the best practices you did for yourself that has made life easier now? You've mentioned a couple, you know, put away $50 a month and things like that. What did you do?
Well, but certainly starting something, and then, you know, making sure that the products and then the investments that you have are going to be beating taxes. So you don't want to put your money away in something that is going to be taxed every year as it grows. So using something like an IRA or a Roth IRA, if you're in business, a simple, a SEP, a solo 401k. If your company is big enough, having a 401k is a good use of keeping people, you know, having investing and all of that kind of stuff. So certainly knowing what's available out there and what you're saving for. You really need to know what your goals are, because it's kind of like a stair step. You have to have your emergency funding. And for everybody, that's different. For some people, it's going to be a couple thousand, you know, 2, 3, 4, 5,000. For some other people, it may be 10 or 20,000. But I met a guy who had 600,000 in a checking account, and it wasn't making any money, which doesn't make a whole lot of sense. So definitely looking at where that money is and where it's making money. And then you want to beat inflation. You want to make sure that the money that you're making is, you know, like the Richest Man in Babylon book. I give that to a lot of my newer clients. It's such a really good explanation of how to make money and how to allow your money to make money. And he calls it making babies or making grandchildren. So, you know, as you're investing, making sure that your return on your investment is higher than inflation. I'm sure you remember way back when inflation was very, very high. And my first house back in 1980, the interest rate on it was 18%.
I was now 21% I was paying on my house mortgage.
Yep.
Yeah.
And, you know, and now it's so low. Yeah. Now it's so low, getting into that kind of investment younger
Right.
is a really great way to go, because real estate is a really great investment, but you have to know what you're doing.
Yeah.
And, so you got to start, you got to beat inflation, you got to beat taxes, and then making sure that you're diversifying. You want to make sure that not all your eggs are in one basket. They're not in one mutual fund. They're not in the same kind of investment product for different types of goals. If you're saving for a house, that's a shorter term type of investment. And, you're not going to be using necessarily a Roth IRA, though you can take out money from your Roth IRA for your first home purchase and not be dinged. But if you've got an individual retirement account, an IRA, that has different rules than a Roth IRA. And so that's some of the explanation that I do with my clients, is help them understand where to put the money that they have for the particular goals that they have. And then if you've got a lot of money saved up, then we can get into more complicated types of products like stocks, bonds, REITs. Crypto now is very popular, but it's still kind of in an iffy stage. And but there's other types of investments that are available, but have your basis first. And I typically start people in mutual funds because they're very well diversified, and there's lots of different types of them for different types of investing. There's large cap, small cap, sector, all of those kinds of things. So you can have your money not all in one basket.
Very cool. Well, Kathy, I want to thank you for taking the time to let us learn from your world. So how can viewers connect with you? I know you're in Be Connected, so they should go to the connection generator. And is it under
Absolutely.
Kathy Peake? And then what other links would you like to share?
Well, my website is T as in Tom, P as in Paul, financial.net. And if they drop me a question in that first page, if you scroll down to the bottom, it has a little question in there. If they send me a little question, whatever it happens to be, I will enter them into a drawing. And so that's one way you can get a hold of me. And I'm also on Facebook under The Peake Financial Group, and I'm also on LinkedIn. So you can find me in all of those different places, but it is The Peake Financial Group. That's what the TP Financial stands for, The Peake.
Awesome. Well, thank you so much. Be sure to connect with Kathy Peake and stay tuned to this channel for more exciting episodes of Reach Millions TV here on the Live in the Hive broadcast network. And to help you reach millions, be sure to grab my free gifts and best resources from jointracy.com. So until next time, I'm Tracy Repchuk, and here's to your continued success.